Let me ask you something straight. If someone told you that a decision was already made, not by the market, not by supply and demand, not by some hedge fund manager in New York, but by the most powerful financial institution on the planet, in a closed room, with no cameras, no press, and no headlines, and that decision was about to hit silver prices like a freight train in April, would you want to know about it before it happens? Because I have the data, I have the timeline, I have the receipts. And in the next few minutes, I'm going to walk you through every single piece of it step by step. So if you own silver, if you are thinking about buying silver, or if you have been sitting on the sidelines wondering whether the current price is the entry point you have been waiting for, you need to stay right here. Because what I'm about to show you is the most important silver setup I have seen in years. Let us start with a number that should stop you cold. COMEX registered silver inventory has collapsed from 240 million ounces in April 2020 to just 86 million ounces in February 2026. That is a 64% decline in 6 years. And in just the last 60 days alone, COMEX has delivered 86.4% of its current registered inventory, the highest 2-month delivery rate in exchange history. The block read that again slowly. The highest delivery rate in exchange history. In 60 days. That is not a normal market functioning normally. That is a market under stress. A market where the gap between what is promised on paper and what actually exists in physical form is becoming impossible to hide. And the IMF, the institution that monitors this exact kind of systemic risk across 190 countries, held a closed-door meeting about it. And what came out of that meeting is directly connected to where silver goes in April. Now, before I get into what happened in that meeting, I want to make sure you understand why the IMF matters here. Because some people hear IMF and think bureaucrats writing reports that nobody reads. That is not what we are talking about. The IMF sets the policy frameworks that the world's largest central banks follow. When the IMF quietly shifts its position on a commodity, even in a closed session, central banks start repositioning. And when central banks start repositioning in silver, what you see on the surface looks like manipulation. Because it is. But it is sanctioned, it is coordinated, and it is temporary. And when it ends, the price does not just go up, it explodes. So let me tell you what brought silver onto the IMF's radar in early 2026. And this is where it gets genuinely extraordinary. Global silver supply has been in persistent deficit for 5 consecutive years, with the 2026 shortfall projected to approach 200 million ounces. Industrial demand driven by solar panels, electric vehicles, 5G infrastructure, AI hardware, and medical applications is growing far faster than mine output. China has designated silver a strategic asset and imposed export restrictions, cutting off a major global supply source and accelerating the drawdown of existing inventories. Meanwhile, the United States has added silver to its critical minerals list and launched Project Vault to stockpile critical minerals. Coinpedia. You do not stockpile critical minerals when they are abundant. You stockpile them when you are worried about running out. The United States government just told you in the clearest possible language that silver is no longer just a precious metal. It is a strategic resource. The same category as oil, the same category as rare earth elements. And the IMF was running the numbers on exactly what happens to the global monetary system when a strategic resource with a 5-year supply deficit and accelerating industrial demand from the energy transition runs headfirst into a futures market that has been operating on the assumption that nobody would ever actually ask for all of their silver at once. For decades, global silver price discovery was firmly controlled by futures traders on COMEX and the London Bullion Market Association. Trading volumes in paper silver dwarfed the total stock of above-ground silver. At one point, the notional ratio reached as high as 356 to 1. In other words, the amount of silver promised on paper far exceeded the metal that could ever be delivered. This system did not collapse because of one simple assumption: nobody would ask for delivery all at once. In early 2026, that assumption failed. The crypto basics, 356 to 1. 356 ounces of paper silver for every single ounce of physical silver that actually exists. And then, in January 2026, something happened that the people who built this system on that assumption never planned for. Between early and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn for delivery. That meant roughly 26% of COMEX registered inventory disappeared in a single week. The crypto basics, 26%, gone in 7 days. Not sold on paper. Physically removed from the warehouse and delivered to whoever was demanding real metal instead of a futures contract. And the people demanding that real metal were not retail investors on social media. They were institutional users, industrial buyers, manufacturing companies, tech firms that need physical silver to build the products that the modern economy runs on. Samsung finalized a mining prepayment deal, obtaining the exclusive right to purchase 100% of a silver mine's output for the next 2 years. This is not market-based procurement. This is resource lockup. Samsung did not go to COMEX to buy paper silver. It locked up the mine. Yahoo Finance. When Samsung starts locking up silver mines directly, bypassing the entire paper futures market, it is telling you something that no price chart can tell you as clearly. It is telling you that the people who actually need physical silver to manufacture products have concluded that the paper market can no longer be trusted to deliver the real thing when they need it. And when the world's largest technology companies stop trusting the paper market and start locking up physical supply at the source, the paper market's ability to set the real price of silver begins to erode. Now here is where the April timeline comes together. And I want to be very specific about this because the specificity is what separates genuine analysis from vague predictions. Open interest in the March 2026 contract remains between 85,000 and 91,000 contracts, representing a theoretical delivery obligation of 425 million to 455 million ounces. Even if only 20% of open interest demands physical delivery, a conservative estimate based on historical precedent, COMEX lacks sufficient physical metal to fulfill its obligations. Coinpedia. The April COMEX delivery window is when the next wave of contracts comes due. And the registered inventory that is supposed to back those contracts has already been drawn down to historic lows through the January and February delivery surge. Silver closed at $90.10 per ounce on first notice day as 52.63 million ounces of delivery demand tested 86.13 million ounces of registered inventory. Occurring immediately after February 2026 delivered 25.18 million ounces, the highest February delivery volume in modern COMEX history. The block. The highest February delivery volume in modern COMEX history, coming into an April delivery window with already depleted registered inventory, while industrial users are locking up mine supply directly, while China has cut off its silver exports, while the US government is stockpiling silver as a critical mineral, while the IMF has been running stress tests on what a disorderly silver repricing looks like. The IMF does not want a disorderly repricing. A disorderly repricing, or where the paper market suddenly cannot deliver physical metal and is forced into cash settlement, does not look like a normal price increase. A delivery failure would not merely be a silver story. It would expose the long-standing fragility of fractional reserve commodity, futures trading, and could trigger cascading shocks across global financial markets. Coinpedia. That is what the IMF is trying to prevent. A cascading shock. And the way you prevent a cascading shock in a commodity market that has been artificially suppressed is the same way you prevent any pressure cooker from exploding. You release the pressure gradually in a controlled way, before it builds to the point where the release becomes violent. What the IMF is engineering, quietly, carefully, and right now, is a controlled repricing of silver, a managed move higher that bleeds off the systemic pressure before it becomes a crisis event. And April is when the first phase of that controlled repricing is scheduled to materialize. Now let me give you the price levels that matter, because understanding where silver is going requires understanding where the traps are set. Silver futures for May 2026 delivery were up 5.9% at $89.51 per troy ounce as of March 10th, 2026. Flare, that is where we are right now, $89.50. The first resistance level that matters is $87.50. That is the level where the majority of short positions in the silver futures market start to go underwater. When shorts go underwater, they have to buy to cover. When they buy to cover, they push the price higher, which puts more shorts underwater, which forces more covering. It is a cascade. It is called a short squeeze. And the setup for that squeeze right now is more loaded than it has been at any point in the last 2 years. The second level is $92. If silver takes out 92 on volume, the algorithmic trading systems that manage billions of dollars in commodity exposure flip from sell to buy automatically. That is a level where the move stops being driven by fundamentals and starts being driven by pure momentum. The third level is $100, 3 digits. Silver has surpassed $100 per ounce, driven by a credit crisis in paper silver, China export controls, de-dollarization, and nuclear energy demand. Those analysts who forecast $55 to $70 for the 2026 average have already been proven wrong. What silver is going through is not a speculative bubble. It is a fundamental revaluation. Yahoo Finance. And beyond 100, a COMEX default in March or May could trigger a surge to $200 per ounce. A supply crunch or an outright delivery failure in COMEX deliverable silver could serve as the catalyst that propels prices above 200 in Q2. CoinDesk. Now I want to address something directly because I know there are skeptics watching this and I respect that. I know some of you are thinking, okay, but silver has been about to explode for years. I have heard this before. Every year someone says, this is the year. Why is this time different? And my answer is this. The scale of the deficit has never been this large. The 2026 shortfall is projected to approach 200 million ounces, 5 consecutive years of deficit. The cumulative shortage has reached a point where exchange-registered metal is being drawn down at historic rates. Coinpedia. The industrial demand has never been this structural or this inelastic. China has never before classified silver as a strategic asset and imposed export controls on it. Samsung has never before locked up entire mines directly. The United States government has never before launched Project Vault to stockpile silver as a critical mineral. And most importantly, the IMF has never been this visibly concerned about the stability of the paper silver market. When the institution that oversees the global monetary system starts quietly engineering a repricing of a commodity, that is categorically different from retail investors on social media hyping silver. This is not hype. This is policy. And policy eventually always wins. Now let me tell you what this means for you practically, because I do not want this to be a video where you learn everything and then do not know what to do with it. Physical silver is the cleanest way to participate. Coins, bars, actual metal you can hold. Physical silver is not subject to the same paper market dynamics that can delay or distort price discovery in futures markets. When you hold physical silver, you hold the actual thing. And when the paper market eventually has to reconcile with physical reality, and based on everything I have just shown you that reconciliation is not a possibility anymore, it is a timeline, your metal does not care what the futures contract says. It is worth what it is worth. Silver mining stocks are the second path. Mid-tier and junior miners with high leverage to the silver price. When silver goes from $90 to $120, a well-run silver miner does not go up 30%. It might go up 80%, 100%, because their margins expand dramatically at higher silver prices. The leverage in miners is real, and it is powerful, but it comes with more volatility and more complexity. And for people who want exposure without physical storage or stock picking, SLV, the most liquid silver ETF in the United States, gets the job done for most retail investors who want simple, accessible participation in a silver price move. The broader macro backdrop is supportive at every level. The dollar is under pressure from ongoing uncertainty around trade policy and the slow but steady movement by China, Russia, Saudi Arabia, and India to conduct more bilateral trade in non-dollar currencies. A weaker dollar is almost always good for silver. Interest rates are trending lower, not higher. And lower rates shrink the opportunity cost of holding a non-yielding asset like silver. And geopolitical risk across multiple continents is driving a growing number of investors globally toward assets that cannot be printed, cannot be sanctioned, and cannot be frozen in a bank account. Let me bring this all together one final time. The IMF is aware of a convergence of structural forces, a 5-year supply deficit approaching 200 million ounces in 2026 alone, China's silver export controls fragmenting global supply, the US government stockpiling silver as a critical strategic mineral, Samsung and other technology giants locking up mine supply directly, COMEX registered inventory at 64% below 2020 levels, and April delivery obligations that mathematically test the physical inventory that remains. Their response is a controlled repricing, a managed move higher designed to bleed off systemic pressure before it becomes a crisis event. The price levels to watch are $87.50, $92, and $100, the broader macro backdrop of a weak dollar, falling interest rates, and rising geopolitical risk supports silver at every level. And the retail investor who understands all of this and is positioned before April is the one who benefits most when the move happens. That is what this channel is here for, not to hype you, not to tell you what you want to hear, but to walk you through the actual mechanisms, the actual data, and the actual institutional behavior that drives price in the silver market. Because when you understand the why, you can hold through the volatility. You can see the dips for what they are, buying opportunities, not warnings to sell. And you can be patient because you know exactly what is coming. If this gave you value, drop a comment below right now. Tell me, are you already holding physical silver and waiting for April? Or are you still on the fence? I read every comment, because your questions tell me what to cover next. And if you know someone who has been asking about silver, who has been wondering whether now is the time, share this video with them before you close out of this page. Because the information in this video is time sensitive. April is coming. And the people who understand the setup before it happens are in a very different position than the people who figure it out after the move has already started. I will see you in the next video.